Good evening, friends. This is Karun Mutha, Head of Investment Insights from HSBC Bank, India. Today we have a special guest with us, and before we speak to him, we know that the ongoing COVID-19 pandemic second wave in India looks like peaking out. Taking a look at the new cases down and increasing the pace of vaccination. But the some economic cost could outlive the duration of the lockdowns. While staggered state level lockdowns feel less stringent than the national lockdown last year, it comes with more uncertainties and timing around it and the impact of it. Well, to hear and understand more about it, let's hear it from the experts today. And we have with us today Mahesh Patil, Chief Investment Officer of Aditya Birla Sun Life AMC. Mahesh, as the CIO, oversees almost 2.7 lakh crore of assets under management and with almost 3 decades of rich experience in fund and investment management. Mahesh leads the entire team comprising of fund managers and analysts, and he personally manages the ABSL Frontline Equity, ABSL Focused Equity, and ABSL Multi-Cap Fund. Has been with Aditya Birla Sun Life since October 2005, and he has been awarded CIO of the Year during that year. Also, to his credit goes the Equity by Asia Management in 2016 and awarded as Chairman's Individual Award by the Aditya Birla Group for being accomplished leader in 2015. Mahesh has worked previously with CMC, Tata Economic Consultancy, Parag Parikh, and Motilal Oswal, and also at Reliance Infocom. So without much ado, we will request Mahesh to take us through the proceedings of the markets and the economy during the past few months, how it has been, and let's hear it from you. What is store insight over the next coming years? So over to you, Mahesh.
Thank you, Karan, for that introduction, and warm welcome and good evening, everyone. Welcome to this session. So, I'll talk briefly for around 10, 15, 20 minutes about the market and how do we see things shaping up in the next few quarters and on which sectors look promising going forward. So as you know, the market, there are two parts to it. One is how the economy is shaping and how the markets are doing. Currently, there seems to be little correlation between that because, as you know, India specifically, we've come out of the first wave of pandemic and we were hit by the second wave, which has really hurt us pretty badly. It has impacted a much larger section of the population, and it has taken its toll on the economy also. The economy was recovering well in the month of February and March. We were seeing a good amount of recovery. A lot of sectors have actually come back to the pre-pandemic level, and suddenly we had the second wave, which took everyone by surprise by the ferociousness of the second wave. The good news is that we've seen the second wave has peaked out. Okay, as you know, the daily numbers are now almost like 1/5 of what they were at the peak, and slowly and steadily the trajectory is going down. And we've seen now lockdowns which were imposed, partial lockdowns in various states, they are getting lifted. So clearly from here on, you should see a recovery of the economy back in shape. Clearly there will be some impact because of the second wave. And we estimate that the impact on India GDP growth will be around 2.5 to 3% or so. Earlier we were expecting in FY20 in this fiscal year, the GDP growth would in FY22 to be around 12.5%. I think it should be around 9.5% or so thereabouts. So that's the economic impact of the second wave. And the second wave has impacted. See, the first wave, it was more about supply side disruptions which were there. We had extended period of lockdowns. In this second wave, it has impacted a larger section of the population. We have had multiple deaths. Everybody around you would have seen in the close family or a near relative, somebody would have passed away. So that has impacted, it has created some amount of impacted the sentiment. To some extent, it has also impacted the demand side also much more than the, I would say, the first wave, because a lot of the savings which were there, which people who got impacted, especially at the people at the lower end, the self-employed people, the savings would have got exhausted. And to that extent, the second wave impact could be slightly longer. But having said that, overall, I think from a corporate India standpoint, if you look at it, I think we don't see the second wave or on aggregate profits to have such a big impact. And there are multiple reasons for that. We'll get into that. So I think the one key question in everybody's mind would be that how can the markets continue to scale new highs, right? I mean, even despite, in the sense of month of May, we've seen the market steadily going up almost every day. And I think the reason for that is, I think globally, while India was going through the second wave, globally we have seen that the second wave had peaked out and things were coming back to normalcy in US, Europe, and global growth outlook is actually going very, very strong. So if you look at US, the growth outlook has been further upgraded, and US GDP will grow at around 7.5 to 8% in this calendar year. And there has been a very strong recovery, I mean, a lot of the sectors which are impacted, whether it is travel, tourism, retail, have bounced back very sharply. And that's why the global markets are doing well. Also, there has been some scare about inflation going up, but the expectation is that the inflation is more because of the supply side constraints, and that should not really trigger into a runaway inflation. And as a result of that, we've seen that the policy makers globally, whether it is the Fed or the EU, they have tried to ensure that the monetary policy remains easy, interest rates remain low for an extended period of time, and also continue with their large liquidity infusion that should continue during at least to the end of this calendar year. And in US, as you know, they have also announced a large fiscal stimulus, since the Biden government came to power, and that is going to fuel the economy. So I think on this backdrop of very strong or stable global growth and liquidity, we've seen the markets are willing to, investors are willing to really look beyond the short-term implication and take a longer-term view. And as a result, we saw some brief correction in the market in the month of April, but it quickly recovered and scaled a new high. And now I think and on domestic side also, with the lockdowns getting lifted, we should see the economy also getting back on stream very quickly. We saw that in the first wave also, that the recovery was very, very sharp. So that's how I think the market is looking at this. And what we think is that the more important question to answer here is that what happens after FY22, right? Because this year your growth will look strong because your base is low, right? FY21, we've seen a contraction of around 9%. So obviously this year will look good. But what happens beyond FY22 and FY23, I think that's a key question. And I think there we remain fairly constructive. We think India is likely to come out of this fairly decent, and a growth post recovery, and when things stabilize, should be probably tracking at a growth rate which is higher than what it was pre-pandemic level. As you know, pre-pandemic, we were growing at, also the growth was slowing down. We were growing at around 5% or so. I think we believe that we should actually bounce back and do much stronger, say around 6.5–7% GDP growth over the next 3 years. And the reason for that are, one is that, see, a lot of the foundation work has been done in the last 5 years. We've seen a lot of big reforms, big ticket reforms, which were done: GST, demonetization, the banking and financial services crisis, and the banking reforms, which came in. All these things had taken its toll, but now I think the government is now looking at how to get growth back, and the budget this time around also was in that direction, and to stimulate growth, even at the cost of slightly higher fiscal deficit. So we, and again, certain sectors, like for example, the real estate sector, which went through a kind of a 5-year period of a slowdown, is now showing signs of picking up. Again, thanks to the interest rates which have come down. Again, mortgage rates are below 7%. So that's obviously aiding, and property prices have remained stagnant now for the last few years, and affordability is slowly catching up. And all the reforms which have happened in the real estate sector is now meaning that there is a lot of liquidity which is coming into the real estate sector from organized sector. So real estate is likely to, we'll see that slowly and steadily improving. That's a big pillar, which is contributing to the GDP growth. Investments overall in the economy have been dwindling for the last 5 years, and had reached a decadal low. There are early signs of that also picking up. We've seen now that a lot of sectors, as demand recovers, we've seen capacity utilizations go up, especially in certain sectors like metals, for example, at record levels. We've seen metal prices at record levels. Companies are making profits. A lot of corporate balance sheets have delevered. They have reduced their debt, and they are now again in good shape to reinvest. And so we should see some revival in private sector capex in the coming years. And also the government is doing its bit to revive the whole investment climate. You would have heard about these production-linked incentive scheme, the PLI scheme as they call it, which the government has rolled out in the last budget, and now it's been rolled out across various sectors where they're incentivizing investments to come in, okay, and investments and incentives are linked to your production, okay, what companies does. And these have been done in sectors like chemicals, electronics, auto ancillaries, and textiles and various other sectors. And that is fueling investments. We expect investments in that space to pick up, not only for domestic, but a lot of foreign investors who are looking at India, not only as a domestic market, but also as a supplier, as an alternative to China, as a global supply chain. I think what the pandemic has done is that it has woken up a lot of the global giants, okay, who were sourcing from China to look at an alternative supply. So the China plus one policy is gathering pace. And India, with its large marketplace and the necessary reforms and the recent reforms, what we are seeing is now becoming an alternative where large-scale investment can happen, which can cater to the global supply chain. We have seen that happen in the chemical sector even before this, okay, in a very big way. And I think that same can be rolled out, okay, for the other sectors as well. So with investments picking up, with real estate sector slowly and slowly coming back, and with government trying to keep a slightly loose fiscal policy to stimulate growth, and with global growth also looking fairly good, that is also driving the export-oriented sectors. Like, for example, the IT sector is seeing a fairly strong demand growth after many years. Again, driven by digitization or digital, okay, which is catching place globally, especially after pandemic. So I think all these, we think that GDP growth should be fairly strong, and that makes us fairly positive on the market, even from these levels, while the market looks fairly expensive at this point in time. But if you take a 3-year view, and if GDP growth indeed comes back to around 6.7%, then your corporate earnings growth, right, company growth should be fairly strong in the next few years. And if you look at corporate India has actually been very resilient and surprised even last year in FY21, despite the GDP growth contracting by around 9% or so. We've actually, the corporate profit growth didn't really fall that much. It was more or less flattish. And that's because many large companies have been able to really cut down on their costs. During this pandemic, they have looked at various cost elements. They have looked on their balance sheet, trying to squeeze out working capital. And I would say they have become much more efficient, much more productive. And that will help them when things normalize. So I would say the corporate India will be in much better shape, much more profitable shape when things normalize in FY22 or FY23. And again, as a result of that, we expect the earnings growth to be fairly strong. This year in FY22, the earnings growth for Nifty companies is expected to grow at around 32%. There could be some kind of downgrades to that earnings because of the second wave impact. I think you will see that after the first quarter, but still it should be around around 25 to 30%. And then I think we should be able to sustain growth at least for the next few years to around mid-teens growth, which is a fairly decent growth compared to the fact that in the last 5-6 years, the Nifty earnings growth has been in mid-single digits. So after a long time, we're actually getting into a good earnings cycle, and a lot of sectors are doing well. It's not a particular sector. Every sector, if you ask me, the outlook is looking better. Even the global cyclicals, IT, okay, pharma, metals, okay, are looking good in terms of the outlook. But even the domestic cyclicals are now likely to pick up, okay, on the back of the domestic recovery we are talking about, be it the banking and financial services sector, or be it the auto sector, the cement sector, even the capital goods and construction, okay, which had a pretty dull run for the last 4-5 years, is likely to pick up. So it's going to be much more broad-based, and sectors contribute to the overall growth. And that makes us much more confident, because it's not going to be a few sectors which dominated the growth in the last 2-3 years. It's going to be much more broad-based. And that is also getting reflected in the breadth of the market, which has also improved in the last 1 year. And we've seen that many companies are doing well. Both the mid caps, small caps are also doing well. And that phenomena, I think, will continue. So we have been positive on the mid and small cap sector now for the last 9 months, and it's done very well. They are no longer cheap now. Okay, mid and small caps are also equally fairly priced. But our belief is that in an environment where if domestic growth picks up, then the earnings growth of the mid cap and the small cap sector is more linked to domestic economy, right? Unlike the Nifty or the large cap companies, if you look at in the Nifty, almost 45 to 50% of the earnings growth are directly or indirectly linked to global growth. So I think in that scenario where domestic earnings growth for mid cap and small cap should do well, I think they should continue to do reasonably well. However, I would like to caution over here that the rally what we're seeing in the market is there's some amount of froth which is coming in, because for the first time we are seeing that the retail participation in the market has increased manyfold, right? I mean, just to give some statistics, institutional volumes typically used to be around 35%, 40% of the total volume, okay, in the market, okay, which is now come down to 15%. And to that extent, the retail volumes have gone up. And as you know, there's been a boom in retail demat accounts, which have been opened up in the last 1 year. People sitting at home probably have got more spare time and they are dabbling in the markets. They have made some good money, and that is probably fueling that. So that retail money is coming in. That is not necessarily smart money, I would say. As a result, we've seen many stocks go up, even some of the stocks without any fundamentals are moving up. So one needs to be very, very careful over here at this point in time when investing, and stick to companies with good fundamentals, with good balance sheets, and not get carried away. As long as you follow that discipline, I think there is still enough room for markets to reward even from these levels. So we think that the returns from the market from here, since the valuation is already expensive, we don't expect any further re-rating of the market, right? But multiples will remain high because interest rates in a low interest rate environment, easy liquidity, valuations will remain a bit higher. But earnings growth is what you can get. So our view on the market is that we should expect around 10-11% kind of a return from here over the next 3 years. Might not be a very high return, but reasonably good return in the context of what other asset classes are likely to offer, be it debt, for example. We don't expect interest rates to really go up, and debt returns will be fairly modest. And while real estate, we expect things to move up in terms of demand, but not so much positive on the real estate property prices. So with inflation remaining, I think around 5 thereabouts, plus or minus 2%, 10-11% kind of a return should be fairly decent. However, investors should, at these levels, I think there is some amount of fatigue which is coming in the markets. Markets are at record levels. There is some amount of uncertainty which is there. So one should be a bit careful over, not go very aggressive at these levels, but stay invested. Definitely one should stay invested and follow a very systematic plan of investing in the market. Maintain the right asset allocation, balance in the portfolio. I would not say go aggressive at this point on equity, but there is still a case to be slightly overweight than a normal allocation to equity even at these levels. Maintain that and continue with your SIPs. I think that's the best way to participate, because I think investors who have waited for a correction, dark correction, have been really waiting for that, right? So it's best to really participate at all levels, and any correction in the market can be used to probably make more allocation, I would say. So that's the broader outlook on the market. Remain constructive on domestic cyclicals. I think we're still positive on the domestic recovery. So banking and financials, banks, the good banks can again bounce back and do well. Domestic cyclical sectors like cement, auto, capital goods have not done so well in the last 2-3 years, but okay, we expect them to do well. And even in our portfolios, we are maintaining a much more balanced approach. As I said, looking at stock specific without diluting the quality of the portfolio. I think because it's very important when you see a sharp rally, there is always a fear of a pullback in the markets, right? Markets could correct. But if your portfolio quality is strong, then you should do well, even if there's a correction in the market. So one can't rule out a correction in the market, but I don't expect the correction to be very deep, if at all, because there is still enough liquidity which is there, which will come back into the market, and the outlook will only at least economic outlook will only improve from these levels. So with this backdrop, I think we can now throw open the floor for Q&A.
Oh, thanks, Mahesh, for that lucid flow of events. And particularly, you started with the global market. So as we assimilate questions from the audience as well, and I think there will be many that is flowing in. Let me start with the first one to you, Mahesh. You talked about the global markets first, and particularly about the US economy. And you said that it is likely to pop up by 7 to 8%. Of course, you meant nominal GDP. But inflation taking a toll again globally, and Fed has been talking of tapering the liquidity program or the bond buying program. Do you believe that any kind of rate hikes and squeezing of liquidity will impact the global markets, of course, and also the emerging markets in India?
So you're right. I think there have been talk about the rising inflation, and markets have been slightly on tenterhooks. We've seen some amount of volatility here at these levels. But talking about inflation, for example, because that's the current biggest risk, if at all, to the markets, because if inflation goes up and goes above bounds, then the central banks, who are currently keeping a loose monetary policy, you could see unwinding of that much earlier than what one was expecting. But here again, I believe that the inflation, while it is higher, I don't see structural inflation to remain high, because currently it's been more driven by supply side challenges, because the increase in demand was very sharp after the pandemic, and the supply response to that in terms of gearing up has been fairly slow. We've seen certain bottlenecks in a few sectors. We all know about the chip shortage, which is there. In US, for example, we've seen there is again been some amount of challenge on the labor side. So I think as those supply side response get normalized, I think you should see inflation kind of moderating down a bit. Yeah, inflation will remain slightly higher than what it was, which was earlier, but should be within a comfortable zone. And that also Fed, as Chairman has said, that they would not react immediately. They will watch for some period of time and let the economy stabilize. So I don't expect, I think, at least US has maintained that they will keep this interest rate low at least until 2023 calendar year and not cut before that. There is chances of the liquidity which has been infused because of the bond buying program which has been there. That could start to unwind. The belief is that it could start to unwind at the end of this calendar year or the beginning of the next calendar year. And that could lead to some amount of volatility in the global markets later in this year. But again, I think the markets will to large extent be driven by growth, because that is what I think drives the market. And we've seen that earlier also in this period, when growth was weak and growth started to accelerate, and that led to higher inflation, and then interest rates start to go up. In the initial period of growth, if the growth outlook is strong, then markets tend to do better even if interest rates move up, because interest rate upward revision is on the back of growth, which is normally supportive for equities, right? Because equities are all about earnings growth.
Sure.
So I don't see one needs to be too worried about medium term, but whenever the tapering starts or whenever there is talks about that, you could see markets reacting to that initially, and there could be correction, and corrections are part and parcel of the market, right? We haven't seen any large correction. It's been a one-way rally. So there is some amount of volatility which is probably likely to be there in the next 3 to 6 months, which one should be prepared for.
Sure. Thanks, Mahesh, for that. You did mention about probably the Fed starting to taper off sooner or than later, and maybe it will take some time really to come out of that global liquidity program. But once the roadmap of the Fed exit becomes clearer and the initial market repercussions have been digested, will it open the door for policy adjustments across the region, particularly the Asian market, because all the Asian markets are really looking up to the Fed to really realign the policies?
So I think the policy realignment happened. I mean, in India also, we don't expect policy rates to remain where it is, right? As it's a common phenomena, right? It's a natural phenomena. See, when the economy is going through a downturn, there is a cut in interest rates, there is a policy response which is there that stabilizes the economy. It allows it to really settle down. and then build the base for the future growth, right? So we are now getting into a kind of a growth phase of the economy, which is already started in the global. In India, it's been set back because of the second wave, but it will also catch up in the next quarter or so. And in that backdrop, see, what will policymakers do is they will not do anything to really scuttle the growth. Their response will be much more graded and much more calibrated, okay, just to ensure that the growth doesn't really become so large and it fuels inflation. So to that extent, they will do that. And on inflation also, I think there is enough. I think we've seen globally also productivity improvement, which is there. So once the supply side issue gets addressed in the next 1 or 2 quarters, I don't see inflation really going up too much. So I think the policy response will be much more gradual, in line with the growth recovery, and that should not really destabilize the market in a big way. And we've seen that earlier also, whether it was in 2003, 2008 period, interest rate went up, policy response was in adjusting to the growth and inflation, but markets continue to rally in that period. So I think, I mean, as I said, growth, earnings growth economy is a much larger dominant factor than interest rates from a medium long-term perspective, for the markets to do well.
Correct. No, coming closer to India, India has been grappling with the second wave. You talked about it in your opening remarks, and thankfully, the pace of vaccination and the localized lockdown have, instead of a national lockdown, have provided a breather. Do you believe still the weak sentiments can overall hurt the growth and the economic recovery? Of course, you did mention about a slowdown from 10.5 or 11.5 expected to around 9.5. But how severe is it going to be really in terms of the sentimental for the at the ground level?
So I think this time around, if you look at, there are two parts to it. One is the second wave has impacted rural India much more than in the first wave. Actually, it didn't really impact rural India at all. In fact, rural India was doing much, but it was more of an urban-centric phenomenon which was there, right? So this time around, it's spread across the interiors, and there is been impact on rural. So you will see rural demand getting impacted a bit than what it was earlier, and it will take time. The good thing is that the rural, with the government support, and government is always supportive on the rural side, and also with monsoons being good and normal, at least that's what the initial indications are. And also with food prices being slightly higher than what they were, there's some amount of food inflation, which is good for rural incomes. It should not be, they should be able to recover much quickly. Okay, and we've seen that rural also, the second wave is kind of receding. So that's on the rural economy. On the urban side, I think the second wave, the impact is much lesser than what it was earlier. But clearly there is, at the lower end of the strata, especially the self-employed, unsalaried people, I think they are impacted much more in this environment, and they will take time to recover. At the same time, because of the sentiment impact, as I said, we've seen a lot of tier ones, people seeing around and getting impacted. So discretionary spend, right, will take time to come back. It won't bounce back immediately once lockdowns are open. It will take time for people's confidence to come back, the consumer confidence to come back, which will probably be until probably Diwali or so, I think, when you will see that thing coming back, unless we don't have a third wave. I mean, that's also a kind of a factor which we need to keep in mind. What happens if there is a third wave which comes in? Only thing I would say is that the second wave has taught us a good lesson, so we are well prepared and closely monitoring, and that's good amount of monitoring has been done by the states and the center to see if there's any spread of that. So we should be able to tackle that much better. But again, that still remains an area of uncertainty, which can cast its shadow in terms of how soon the pace of recovery will be from here.
Sure. No, before we proceed to our conversation, there is a there are questions from the participants as well. So I'll just take up a couple of them. So the first one is from Mr. Madhusudan. He wants to know about the debt yield. So basically, he's asking whether the debt yields, considering they're at the lowest rates now, when will the cycle expected to reverse and to go up? And is debt, banking and PSU sector and short-term more safer bet than the credit risk? You want to take that? Of course, I know you are on the equity.
Yeah. No, I can take that.
Yeah. So
on the debt side, our view is that the policy rates will remain over here. We don't expect them to really go up. Okay, though probably later part of this fiscal year, you could see that turnaround. And 10-year bond yields will remain at views until this, it should remain somewhere around current levels or so. So we don't see that really spiking up too much. And so to that extent, only thing is that the rates are bottomed out. Is very sure about that. So you will not see any large. Normally in debt, what happens is that rates go down. There is a capital gain which is there, and that helps you. And that's the period which we saw in the last 1 year or so, right? And that's why
Yes.
while the rates were going down, the returns of some of the bond funds would have been better. But that's no longer there. So what you'll do is you have to really, and rates will go up from here. Okay, it's a matter of 9 months or whatever. So you don't want to have larger duration also, right? If you're carrying a larger duration, then there is a capital loss which is there. So the sweet spot is basically accrual kind of a strategy with 1 or 2 year kind of a duration, and really to invest with that kind of a horizon. I think that's the best way to do it. And that can be done through a banking and PSU fund, as somebody mentioned. I think that's the right way to approach that and play that. I would not advise credit risk funds and other funds. While I think on one hand, I think we've seen the worst of the credit crisis, especially the corporate credit crisis, and that's largely behind us. In fact, the corporate credit cycle is expected to behave well from here, because corporate balance sheets are now pretty well delevered. We've seen the lot of stress sectors, where the metals and other sectors are doing well, and seeing good amount of liquidity coming in over there. And at this cycle, at the beginning of the cycle, one should still be okay. But I think looking at the fact that some of the uncertainties which are there, I think one would still not want to go aggressive on a credit risk portfolio, but a high credit kind of a fund, credit risk fund, AA and above, I think can definitely be looked at. So I think lower duration, not very low, because very low duration also rates are very low, right? If you look at short duration. So the sweet spot is between 1 to 2 year, I would say, or 3 year duration, and with moderate credit risk. Because if you go for a AAA, then the spreads have very narrowed down, right? And you don't want to go down below liquidity. So somewhere like a AA plus, I think kind of a portfolio, I think should give you better yield and a better carry in the portfolio.
Sure. Thanks, Mahesh, for that. And coming back to our conversation, you were talking about the urban and the rural demand. And I think the biggest cause of worry today is that during the last lockdown, which was a national lockdown, the urban or the affluent class led the rise in demand post the national lockdown. Do you believe that the rural demand may play a bigger role in the pent-up demand this time? But there is a continuing dilemma that this disease is spreading in the rural heartland. So do you believe the rural demand may not be as dependable, though it may likely to be pent up demand?
So I mean, that is one of the concerns which was coming up, and we saw that impacting, right? I mean, this time around, tractor sales and this thing got impacted in the month of May, because rural India, we saw, I mean, many people getting impacted on the second wave over there. But I think rural India is more driven, and as now things are normalizing, and number of cases are coming down, I think rural India will also come back very fast. And I think as we get into the season, right, the Kharif season, so with good monsoons around, and government supporting, a lot of the state governments also supporting the rural population in terms of providing them the liquidity. Again, the banks are also there to provide the liquidity. So I think they should be able to bounce back fairly well. I think for them, more important, I mean, the second wave, I think with the cases coming down, I think the mobility impact which was there, that is coming down. Now it's more about the income side, right? So income side is the more dependent on the monsoons, for example, how the food grain prices are. I think that drives the rural income. And on both the sides, I think things are looking positive. So I would not, I don't expect, while it will be slightly slow to come back, because sentiment is still got impacted over there. So the pent-up demand won't come back slowly, but immediately, but slowly and steadily as the sowing season goes through and the crop is good, right, and prices are good for farm produce, I think you should see rural demand slowly coming back. Typically, it will come back post Diwali. I mean, that's where they get the harvest. So I think until then, I think it might remain a bit weak.
Sure. Uh, the dominant narrative this time in the bid to keep the economic cost low of the pandemic, national lockdown was avoided, though there were geographically state level lockdowns that were imposed. You did mention about the impact on the GDP growth as well, and RBI also have revised their guidance downward. But particularly, can you take us through what are the key sectors that are likely to be impacted in the slowdown that may be possible in the next financial year?
So see the sectors clearly. I think the domestic sectors, focus inward-looking sectors, are getting more impacted. And we all know because of the impact on mobility, we've been seeing that malls have been shut down, restaurants are still shut down, and they'll open much more slowly. So the retail sector clearly has got impacted in a big way. And though I think when things open up and normalize, there'll also be pent-up demand, they'll bounce back. But clearly in the interim, we've seen a large impact over there. Malls, I mean theaters, exhibition, entertainment, and all those travel related industries have seen a big impact. So, which is obvious, okay, because mobility has got impacted. So those sectors will take that; they'll be the last to recover. But when they recover, I think in FY23, I think I expect a very normal year, because you would have bulk of the population being vaccinated, so that fear will be, and so you'll be a bumper growth in these sectors, right, which have got impacted: retail, travel, tourism, entertainment. So it should do very well in the next fiscal year. But this year, okay, there will be an impact definitely over there. Apart from that, I would say auto sector also got impacted but again, there the pent-up demand could come back a bit in the second half or so. But yeah, clearly full year numbers would definitely get downgraded for the auto sector. So I would say some of these domestic centric sectors which are there, retail and consumer facing, I think is where the outlook, at least for this fiscal year, would have got downgraded because of the second wave.
Sure. No, there are questions flowing, on the various sectors as well. And there's a question from Shivaji Kelkar. He wants to know about a particular stock, but that I would not take. I would rather take it as a sector. So he wants to know about the pharma sector and what is your outlook on the pharma sector as a whole. We have seen actually pharma giving one of the best returns over the last 1.5 years. What is your take on the pharma sector in particular?
Yeah, so you're right. The pharma sector did very well even during the pandemic when it broke out. That was the best performing sector, okay, which was doing well, and it's continued to grow steadily from there. So on the pharma, we saw, I mean, a year back, 1.5 years back, the sector was fairly undervalued. Okay, it had big amount of underperformance prior to that for 3 years, and we also gave a big call on pharma sector to go over around 1.5 years back. Since then, it has done very well, and there's no longer a valuation discount there, right? The stock prices are, the overall average multiples of the sector are now somewhere near the long-term average or slightly higher than the long-term average. So it's no longer cheap. But pharma sector will continue to do well, right? I mean, Indian pharma companies have shown the resilience, and especially domestic pharma, I would say. Domestic pharma is likely to grow at a steady pace of around 10 to 11%. And because of the focus on healthcare, health insurance, it has a good long-term growth prospect. So good, strong domestic pharma franchise, I think, would be steady compounders going forward. And especially companies which have got a more chronic portfolio, right, will do well. And other than that, I think the pharma sector will be more stock specific, because in US, the whole US generic space, which has been there, we had seen a lot of price erosion around 2-3 years back, and that has stabilized now. But Indian companies need to continuously invest in R&D to come up with new products, okay, which can sustain the growth rate in the US market. So companies which have got a very strong investment R&D and a strong product pipeline will continue to do well. The pharma sector also got benefited. Few companies got benefited because of the pandemic, right? So there was demand for a lot of these COVID drugs, whether it is remdesivir or other drugs or anti-uncertain. So that demand will probably moderate down a bit. So one should just keep that in mind. But I would say pharma would remain more now stock specific. The valuations are now fairly priced in that sector. There's nothing which is cheap. There is also the pharma API story which is playing out. right? Because of the China plus one policy, and a lot of global players are now looking at outside China as an alternative source for APIs, which is the key raw material or one of the raw ingredients for making the pharmaceutical products. So there, I think the Indian companies have benefited some of these players immensely, because earlier that space was a commoditized space and there was a lot of pricing pressure which was there. But now it's opened up a larger market, okay, where companies are now investing more into the API space. So that can be an interesting long-term opportunity which one can look at. But again, the safest play will be domestic pharma, I would say.
So Mahesh, when you mention the API as a sector, do you think that there are thematic funds which allow you to invest, or it will be only pharma funds as themes that would be really programmed to really capture that momentum?
So I think it will only be the pharma, because see, API is a very, very small niche sector, right? It's even a sub-segment within the pharma. And again, while it looks good, right? There's been a sharp increase in API prices, the companies are benefiting, but you never know, right? There could be some amount of moderation over there. One has to wait and see. It's always not advisable to go into a very narrow theme. It's better to play a slightly broader theme, because in pharma, you can play through multiple ways, right? Domestic pharma, you have the US generic space, you have the product companies, you have the biogenerics companies, you have the therapeutic companies, the diagnostic companies, which are the hospitals. So if you play the pharma and healthcare space, that becomes a good theme to play. And one can definitely play that through a pharma and a healthcare fund, which has done well. But there are multiple drivers to it, right? So to that extent, it reduces the risk of a small niche sector, which can be doing well, but it can, I mean, its market would already discounted that, and it can also come down equally sharply if things go wrong. So I would say the best would be through a bank, pharma and healthcare fund.
Correct. One of our participants, Sangeeta, wants to know which of the thematic funds do you feel are the best to invest going forward?
So let me say that for thematics funds are not for everyone. It's only for people who are aware about the risks and the kind of volatility which these funds come with. But if somebody is willing to take that risk and making a small tactical allocation in that space to get the higher alpha or a higher return, then I would say that again, I have positive on the domestic growth and recovery from here. And if one wants to play that, then the banking and financial services sector could be a good thematic to play the broader recovery in the economy. Also, the credit growth has been fairly weak now for the last 1 year. I think it will slowly pick up, though we don't expect a big acceleration over there. Overall, the sector is now at fair multiples. I mean, compared to the market where it is slightly higher than the long-term averages, the banking and financial services sector is still at fair multiples. Sure. A lot of the large banks have been tested during the first wave, and they have emerged with not big scratches to the NPAs. I mean, and they have made adequate provisions. So don't see a large impact because of the second wave. Bank balance sheets also, a lot of large banks have now capitalized well. So they're sitting on good amount of capital. And also the overall other sectors, secular, like insurance, for example, which is a much more secular growth and long-term growth story. So I think one can really look at the banking and financial services sector to play that. And we've seen that the BFSI index has across the market cycle also done slightly better than the Nifty. And since we are coming in from a bottom of the cycle, in a sense, so the stocks have rallied a bit in the last 6 months, but still they're not as expensive. I think it could be one of the thematics if one would like to play.
Yeah. Mahesh, sorry. Mahesh, you talked about the financial sector, but the sector is actually grilled with two twin balance sheet problems that has been there around for a decade. Many banks are getting really risk averse and suppressing investments. Do you believe that the concerns at India's finance sector should really drag the potential credit growth further lower?
So you're right, actually. The banks, especially in the corporate sector, right? So banks have been averse to lending to large corporate, leverage corporate, let me put it this way. Also to the infra sector, sector, clearly many banks have pulled out of that space. And that is kind of some of a challenge in terms of, because to grow, a lot of corporates would require debt capital. And to that extent, a lot of banks' focus has been in growing the retail book, right? Because that's, people have found it to be much more safer relatively, I would say, and they better yielding in terms of returns. So focus has been to grow the retail book, which is nothing wrong with that. but the corporate growth has been very, very sluggish. In fact, it's been negative. And to that extent, you are right to some extent. But what is happening is now that banks finally, I think, as they're sitting on excess amount of capital now, right? So I think once things settle down and now the overall corporate as GDP growth picks up, you will see corporate credit growth pick up, working capital requirements will go up. So slowly and steadily, I think the banks will start to lend again back to the corporate sector because they can't sit on so much of liquidity, right, which is not yielding them any kind of return, and the short-term rates are very low. So the credit deposit ratios are very low, and beyond account, you can't aggressively push on retail credit. So I think they will come back and start lending. They're probably much more cautious and much more judiciously, and which is good, I think. And for the large infra projects and this thing, they would have to look at other alternatives, right? And that's what the government is trying to develop the bond market, okay, or looking at external borrowings, right? A lot of these long-term funds, pension funds, okay, which can look at some of these assets. And what the corporates are doing also are there's a now lot of interest coming in REITs, right, or InvITs, as we call them. So a lot of infra companies which require capital, okay, to invest into assets are now monetizing some of these through the InvITs. And say for real estate companies are doing it through the REIT structure. And there are large investors, global investors, who are looking at decent yields, okay, in an environment where there is low. So that is also happening. So that is able to rotate some of these corporates are able to get release some of the capital, okay, by monetizing some of these assets, okay, what they have, and getting that growth capital back to invest into future projects.
Sure. No, Mahesh, the biggest dilemma for the investors now, because they look at the index, and which is a number at a relatively higher level than what they have ever seen. Now, the biggest question for them is whether to invest or not. And of course, you look at valuations, and the markets are a slave of earnings, as everyone knows. But even on that front, we look that the price to earnings are quite expensive, and even on the price to book metrics, we are on expensive. So what an average investor should really do in these scenarios? Should he book profits and probably set aside or rebalance his portfolio and maybe look at a correction and switch back? So what is your final piece of advice towards that?
So as I mentioned, I think one has to really look at the market and look at what is the medium to long-term view. So as I mentioned earlier, I still remain very constructive on the market from a medium to long-term. As I said, we are coming out from the lows. I think growth will pick up, and I'm positive on growth. So I still expect, even from these levels, market can still give you around whatever 10% kind of a return, which is still not bad. And though I would say that, yeah, rebalancing your portfolio is required, especially when we've seen such sharp movements in the market. I think that is a must. You should always maintain that target allocation, what you have, based on a risk appetite. And if it has gone up significantly, deviated from that because of the market appreciating, I think it's a good time to rebalance that, especially at these levels. Near term, I don't see a big upside in the market. As I said, you have to certainly look beyond next 1.5 years now in the market to make returns, right? Because the market is already discounting the next 1 year or so is clearly there. So you have to really look beyond that and take a horizon, say, with that view, right? If you with the 1 year view, probably the risk reward doesn't look that great on the market. But equities is all about investing from the longer term and benefiting from the long-term returns of equities and the compounding power of that. And for that, investors looking to do that, I think clearly, definitely they should stay invested, obviously keeping their target allocation in mind. Even if you are slightly higher than your target allocation of equity, I wouldn't mind that, even at these levels. I think it's not a time to exit the market. You have to be a bit cautious over here. Don't go aggressively. And just because past returns have been good, aggressively allocate. And that, I think one should not do at these levels. Remain more balanced in allocation. And yeah, apart from that,
would SIP be the right approach, Mahesh?
SIP is always the right approach, no? I would say at any point in time, because you don't know, right? I mean, many people, and we also thought probably the markets would correct, right, after the sharp rally and second wave, which came in. It corrected briefly for around 7-8%, bounce back again, right? And if you would have waited for that, that I'll get the right entry point, you would have just not been able to participate in that. Similarly, when the market rallied also, I mean, during the pandemic, I remember many people were still thinking the market will still go down further and we don't know where the bottom is, right? and then it bounced back very sharply from this low. And people who were waiting there again would have got napping over there and not able to enter. So I think SIPs remains best way to invest market at all points in time, I would say, especially at times when the when the risk reward is very well balanced, which is important. Market is not very attractive, right? You can't say that I can go aggressively and deploy money in the market, which was probably a scenario, say, around 6-9 months back. So in that scenario, you don't know, but outlook is still good. It's not very expensive also. People say the market is expensive, right? You ask people, say that P multiple is at whatever trading P multiple is 24, 25. But I'm still not so worried because one is the price, but the earnings part of that is very, very depressed. So the earnings are at a decadal low, right? Your corporate profit to GDP is at a decade low, and it will only reflate from here. So it's not a combination. When a combination of high prices and higher earnings, right, and a strong economic growth for a few years, I mean, that's where I would be a bit worried. So one part, prices are expensive, but earnings are depressed. So that balances out a bit. So markets, that's why I'm not too worried. Yeah, but your returns will be more modest from here. It won't be very large. That's what one has to accept.
Very true. The returns are likely to be modest. And the last one, which is coming from Madhur Kripal, and he is just asking you the two best thematic sectors that you would really bet on going forward.
So as I mentioned, one was banking and financial services sector. I think here from here on, I think looks fairly reasonable. I mean, there are some people who want to take a slightly higher risk. I would say the capital goods sector or industrials, okay, is looking poised for doing well again. There are some indicators. There's a capex cycle coming back, and sector has not done well for the last 4-5 years. And there are good companies. One can, but it's a very small, narrow sector. Apart from that, I would say, I mean, the best sector which I see do well in India is the consumer sector, consumer discretionary, right? Or retail, because India is still a growing country, per capita income going up, penetration level, a lot of categories are low. So for me, the evergreen sector is the consumer, not exactly consumer staples, FMCG, but the wider consumer sector, right? Small ticket consumer discretionary. So we have a fund which is Gen Next fund, right? Basically, is targeting invest where the Gen Z, the next generation, is spending all those sectors. I mean, that fund does well across market cycles and a steady compounder.
Absolutely. Thank you, Mahesh. I think that was really a fantastic allude, and we'll take forward from here. And you said that the markets are likely to give modest returns because it has already moved up significantly. But yes, the long-term investment mojo is still going to be there. And of course, the earnings are likely to be growing very fast, at least for the next couple of years. And we will look forward for markets staying or growing out from here. Thank you, Mahesh, for joining. This is really an exciting session, and we look forward now having more of such sessions with you.
Sure, my pleasure. Thank you.
Thank you. This concludes the session for the day.